You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. This should be the second podcast of the week. The first podcast was part of our Back to School series, which is a series where I'm trying to sort of go back to basics and make sure that if you are trying to get an idea of the world of personal finance for yourself, that you have some opinions. And I'm calling them opinions because it's not like just because I said it, it's law. It's just the way I see personal finance and some of the things related to that, like asset protection and estate planning and all that kind of stuff. But anyway, this particular podcast is part of our usual rotation, and it involves the real estate market. Now, as I mentioned, I'm coming to you from Montecito, California. It's a small beach town of about 5,000 people at the southernmost part of Santa Barbara. And if you've been listening to this show for years, you probably remember some of these transitional shows. I mean, literally, when I decided to move to Montecito from Chicago, I did a show that day. It was crazy. Anyway, I moved here in 2017. Started out as a renter, because one thing I learned over the years is that whenever I moved to a new area, I always ended up wishing that I lived in a different part of town. So based on that, it's probably better not to buy right away. And at that time in Montecito, again, 2017, coming from Chicago and the northern suburbs of Chicago, which aren't cheap, I had quite a bit of sticker shock. Just to give you a reference, now, I had a house in the northern suburbs of Chicago. It wasn't cheap by any means, as $2 million, but it bought me a 7,000 square foot home with 2.5 acres and an indoor pool. And when I got to Montecito, realized that $2 million didn't get me much of anything. Maybe a garage and maybe a 2-bedroom, something like that, little starter house somewhere. But anyway, barely. So when I saw that change, I needed some time to digest the new reality for a bit as well. I couldn't, jump into that. And in hindsight, though, that wasn't maybe such a good move, because since 2017, Montecito homes saw an average sale price increase of over 60%, the steepest rise in prices in California during that time. And to be frank, that 60%, that doesn't even sound right to me, because I literally saw houses that doubled in prices during this period. So COVID didn't help. There was rich people from LA, San Francisco, and New York that realized that if they had to work from Zoom anyway, they might as well do it from Paradise, where they could also hike the mountains and go to the beach the same day. They were seeing how the Royals moved and how Oprah was here and Ellen DeGeneres and all these stars. And there's been a lot of spotlight on Montecito for that reason. So anyway, created a big, big mess. What else didn't help in terms of this housing market going crazy over here and in the rest of the country? Low interest rates, although I have to say that there was a lot of people buying $10, $15 million houses here for cash, and the amount of those people is sort of unreal. But, as for the rest of the country, the suburbs pretty much took off everywhere, right? Near zero interest rates and nowhere to go. Made people basically buy nice homes, so they had something to do, some place that was nice to stay while quarantined. Now, quarantines obviously are over, and interest rates are high. And so when you put those together, you might think, man, home prices would have fallen off the cliff. Nope. Remember, it's all about supply and demand. Right now, supply is low. Why? Well, if you bought an expensive house at a fixed rate in the past few years, would you be selling anytime soon? I mean, since that time, mortgage rates more than doubled. In other words, many people today couldn't even afford the house they bought a few years ago. Just interest rates made it so that they could buy them. And frankly, that's a problem across the country. And as a result, supply is so low that even minimal demand is keeping housing prices high. And all I can say is that, I did end up buying a house before things got too crazy, and I'm very thankful of that. Otherwise, I would have been a renter in perpetuity. But you know what's crazy is I had to buy anyway because people who were renting their houses, and there was a very high percentage of people who were renters here in Montecito because of the housing costs. But everybody was ultimately getting kicked out of their rentals because, of course, people wanted to capitalize on these assets that had doubled or tripled since they'd bought them. So anyway, probably a good thing anyway. Got a house where I'm podcasting from now. Anyway, the issues around real estate prices right now even are very complex, but they really are worth understanding, especially if you're in the real estate investing kind of mindset. My guest on this week's Wealth Formula podcast is an economist who specializes in these specific issues. So make sure to tune in and see what she has to say about this very unique time in real estate history after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Selma Hepp. Selma is the chief economist for Corelogic, America's largest provider of advanced property and ownership information, analytics, and data-enabled services. She leads the economics teams, which is responsible for analyzing, interpreting, and forecasting housing and economic trends in real estate, mortgage, and insurance. Selma, welcome to Wealth Formula Podcast.
Yeah, thanks for having me.
So, let's kind of start with some of the interesting things that have happened. Obviously the inflation and interest rates and all of that have created a little bit of a mess for real estate in general. But in the last month, we actually saw inflation down to its lowest in 2 years. Does inflation still pose a significant risk in the real estate market? And what do you make of the new data?
Well, we've seen some disinflation happening, right? And most of it is sort of leftover effects of supply chain disruptions, and then also the core, the non-core, so headline inflation in gas prices and food prices, right? Now we have this leftover services inflation that's a little bit more stickier than the one I just talked about, and it's making it difficult to to sort of expect mortgage rates at this point. So the impact we're talking about here is mortgage rates, right? That's what matters to us the most. Right. And unfortunately, we were all sort of thinking mortgage rates would start declining by this point in the year and reach some less than 6% levels by the end of the year. Now, things are looking a little bit different at this point because the inflation persisted, because the Federal Reserve signaled that they will do 2 more hikes this year. And naturally, sort of bond market said, okay, well, I guess this is a longer, higher for longer, right? And we are not going to see the cuts that rate cuts that we were expecting by the end of this year. So unfortunately, we are in this environment of elevated mortgage rates that are causing some constraint on the market. On one hand, they are definitely dampening the demand. So we've seen pretty strong demand coming into the first few months of this year. And then with the banking turmoil and mortgage rates going up, that demand has definitely shifted down. And sales activity at this point is trending anywhere from 20 to 30% below last year or even below 2019 levels. But the issue that's the bigger issue, I think, at this point is that high rates are keeping existing homeowners in their homes because they don't want to give up that low mortgage rate that they lock themselves in, not to mean that with a negative connotation. I think it's good because it lowered their mortgage payment, but they really don't have an incentive to give up the rate right now. And so we are in this quagmire of, really, nothing is moving that much, at least in terms of the existing housing market. So, to circle back on your inflation question, I think it is posing a concern in the sense that Federal Reserve is laser focused on that 2%. It may take us a little bit longer to get to 2%, and it may really be not well for housing market going forward, which at this point we were already expecting it would sort of bounce back. So that's
just unpacking a little bit of that. I think what I gathered, and I've heard this idea before, is if you look at prices nationally, based on what's happened with interest rates, you would maybe expect that prices would have gone down a lot more. But because of the fact that, frankly, a lot of people are locked into low interest homes, there's really no incentive to get out of those. And so that's creating a significantly decreased inventory. And so that is essentially, sort of stabilizing prices there as well. Is that right?
Right. So I think, to give some silver lining on this situation is that it has provided, these low inventories have provided a floor under home prices. So where we entered the year expecting double-digit decline in home prices nationally, or some were expecting that, not Corelogic forecast, we were not there, but we were expecting some national decline. We're not seeing that. We actually, as of the February of this year, we started seeing a very strong rebound in monthly gains in home prices, well above what we would traditionally see in the spring home buying season. Because usually you do see some increase in home prices; it's a seasonal effect. But this time we again saw a much higher or much stronger gains than historically. And so what that means now, that for nationally, Corelogic forecast is for no longer to see any recording of a year-over-year decline in prices, but actually at this point an inflection and an appreciation on a year-over-year increase in appreciation on a year-over-year basis. So it's a good and bad, right? It's good because it's provided sort of a stability to the market, right, which was much needed. I mean, I think stability, particularly when you have consumers being concerned about the housing market and sitting on sidelines, giving them some sense that home prices are not going to fall fall off the cliff, they do respond well to that. But I think unfortunate thing at the moment that I keep thinking about more and more recently is that this reacceleration in home prices is not going to be good for inflation, because inflation, housing inflation is 40% of overall inflation measure. If we see home prices going up again, that doesn't line up with the Federal Reserve's policy, so we got, both sides of the coin here.
Yeah. Well, it's a strange thing to me, because to a certain extent, I would think that even with decreased inventory, that there would be a cap to what people can actually afford, and having, the affordability being the, sort of the last wall that prevents, prices from going up further, but that's not happening.
Yeah, no, I mean, I think affordability is an issue. And, in terms of where typical mortgage payment is, historically speaking, or just affordability levels, we are at the lowest affordability level on record, or not on record, maybe going back some 40 years. So, in many ways it is on our lifetime record that we know. But, I think what's driving the demand, despite this affordability challenge, is that people are moving across state lines. They're going to areas that are more affordable to them. And the other thing is, because home prices have gone up, some 40% since the beginning of the pandemic, and on average, people have almost $300,000 in equity. They have a lot of cash to work with. And I think because of that, we continue to see pressure on home prices, particularly in markets that are more, relatively speaking, more affordable. So,
right,
the Southeast, South, whatever, Florida, that's where you have a lot of migration to, and it's holding prices high, so it's not just about affordability of local residents, but it's we're having this new trend introduced to the housing market, which is migration patterns, the ability to work for many out of destinations that they were not able to from before, right?
Sure. Obviously the paradigm is quite a bit different when it gets to commercial real estate, large multifamily, or office, or anything of that. Give me sort of a similar outlook, or not outlook, but sort of maybe just tell us where we are right now first with regard to the interest rates and mortgages that we were talking about before when it comes to the commercial markets.
Right. So, I think the challenge with commercial market, well, there's a couple things. One is office commercial. Every segment seems to be performing a little bit differently at the moment. Where multifamily housing, it has slowed to the similar extent that residential has, the single family residential or homeownership market. But apartments and multifamilies are now actually performing well again, given the strong job market that we've had, strong income growth, household formation. When you think about an apartment market or rental market versus a homeownership market, rental market is much more dependent on that job growth and household formation. Whereas homeownership, it's a couple other things, but So multifamily, in my opinion, is not doing as bad as we thought it was going to be doing.
Yeah.
Now,
at least yet, right?
At least yet, yeah.
Right.
I mean, I think even with job. The forecast for unemployment rate of unemployment going forward, I mean, it looks like it's only gradually going to increase, and that increase is expected to come to some 4.5% by the end of 2024, which is really where we historically have been in terms of rate of unemployment. That's sort of what a lot of people consider natural rate of unemployment, where the job market is not putting additional pressure on inflation, right, because of that wage growth. The
only thing is, though, that with regard to to me, like one of the major things that's different here is, first of all, when you look at larger assets, commercial assets, multifamily, debt structures are often very different. And also, like when you get into these situations where, funds need to deploy capital, or vice versa, they need to get out of real estate because of a closing fund and that kind of thing. How do those things affect what you see? I guess maybe you just start with the interest rate and, different mortgage structures there, because certainly, most of the time, even if you're fixed for 5, maybe 10 years max, and a lot of commercials still floating as well. So,
well, right. I mean, I think what's the challenge right now is for commercial is that that there's this huge volume of commercial real estate that's maturing, right? And so now they're maturing in this really high rate environment. And so what happens with those mortgages and those assets? I think a lot of people are talking about a wave of defaults, particularly for office group, but we're not really yet seeing that in many ways. So I don't know if people are working out. They're maybe getting some private funding, some equity private funding to help in this refi restructuring, or maybe they are subleasing. I'm not exactly sure, but because we don't track to perform commercial performance that closely in our data. We're mostly residential. We're very strong on all types of residential data, not so much on commercial. So, but at least what was expected that would be happening at this point is not yet. I mean, we're not seeing a wave of defaults. We've seen the serious delinquency go up for commercial, and it has gone up, maybe faster than than historically, right? So
Right.
but the actual default is not happening yet. So
How about delinquencies and defaults in multifamily, so apartment buildings? Do you have some data on how distressed that market is currently?
Yeah, no, it's a very similar story where we've seen some increase in delinquency, so non-payment, but nothing that is yet, significantly alarming, So that's what I mean. I think there's some workouts being done there, or maybe we have presumed a much worse outcome than it's in fact happening.
Yeah, although I would argue that one of the things that's keeping this market afloat is right now is a lot of interest rate caps.
Right.
And those interest rate caps that were purchased are basically stabilizing a lot of, floating rates. And the question is, what happens when those caps start to expire? And, there's either you're going to buy more caps or you're going to develop. So the question is, I guess, in part, like what we're trying to figure out in our group is, and I guess what we're presuming is that there's a pretty significant wave of distress on the way. But it sounds like from the data that you're seeing right now, that's not clear.
It's not clear. Yeah. I follow that, maybe down the road, but I guess what I'm just saying is we're not yet seeing that,
What are some of the other, I guess, things that you're looking at in terms of, say, longer term, geographically, what markets are becoming increasingly strong? Which markets are perhaps weakening? What kind of projections do you have on those types of things?
Yeah. So, it seems like things go up, things come down, right?
Sure.
And so it's very much the trends. So what we're following is the trend with, that pandemic started with is so markets that were really strong at the beginning of the pandemic were markets in the Mountain West, markets that were second home markets, vacation markets, just areas that people could be outside, right? I mean, natural extension of what was going on. And now these are the markets that are the coolest, and particularly if they, if this affordability that we talked about has, been really crushed with the rate of appreciation. But now, fast forward to where we are today, markets that over the last year were really hot, and those were particular markets in the South and Southeast. Now they are cooling really fast, so Florida to some extent is cooling faster. Some markets in Texas, some markets in Nashville, in Tennessee, Carolinas, those are the markets that are cooling relatively faster. And the markets that are rebounding are the markets that were cool throughout the pandemic. For example, Chicago, Midwest markets, Boston for a long time was a very cool market during the pandemic. New York too. These are the markets where we, in terms of rents, are now seeing those markets sort of ranking on top of the list. So, it's sort of a, shift. And again, it's, it goes down.
So it sounds to me like you're talking a little bit about is, people are moving back into cities.
Yeah, I think we're seeing that. I think we're seeing that, which I think why maybe I'm not so negative on the commercial real estate or, office, talking about office here. I think some markets will suffer more so than other markets, but there are many markets across the country where people are going back to the offices, or they've already been. They haven't been away from the offices as much as we talked about. We it seemed to emphasize a couple markets and say that, and then generalize that all the trends are the same as in these couple of markets, where every market seems to be different. So yeah, I would say that, there is pressure, particularly from management, for folks to come back into the offices. People want to go back to the offices, and they want to go back to wherever they were from. Maybe, I think in many ways, for some people, the migration was temporary during the pandemic. They didn't permanently move to, I don't know, Tennessee, or Nashville, Tennessee, because that was sort of one of the boom markets during the pandemic, or Boise, Idaho, but it was a temporary move, right? Sure. So, so I think we're just seeing some, readjustment.
Yeah. So in the cities, and I don't even know if this is really necessarily part of something you would look at, but I know there's some government plans to, going back to the idea of people moving into cities, to convert urban commercial buildings potentially into some affordable housing. I don't know if you've heard of that, but
yeah. No, yeah, that's a huge topic at the moment, and a lot of people are looking at potential build outs, sort of capacity, but what it seems to be. Well, at least from the research I've seen so far, it seems that the office building that provide most opportunity for such conversions are offices that are not located in downtowns and urban centers, but are more suburban, older office building. Those spread out. What do they call them? Like office parks, mm-hmm. right? Versus, you think downtown, I don't know, San Francisco or downtown LA. It's those office buildings are much harder and costlier to convert. So, so I think the enthusiasm is there. I'm just not sure to what extent is really realistic in many of these markets. That definitely actually need affordable housing.
Yeah, sure. So in going back to the Fed and interest rates and inflation, I guess from your, as an economist, what are your projections? What do you think is going to happen? Obviously we've got the Fed talking about 2 more rate hikes, and nothing so far has really, I guess, there's been some bank failures. Obviously, there's been some distress in the market, but not as much as you want, or not as much as you would expect, I guess. The question is, do you think that there's just, at what point do they stop raising rates? As an economist, when you look at that, is it just you're looking for a solid 2% inflation rate, and then you've got, Is that the only thing that we're looking at there? What if a lot of things start breaking?
Right. Yeah. I think, there's a couple of things going on here. I think one is Federal Reserve's, what is the word?
Mandate?
No, confidence in federal, like their reputation, or that's
mm-hmm.
not the right word, but, trying to maintain a confidence in their actions, right, by markets. So they have been very persistent on saying that 2% is the goal and target, and that they're not going to give up until I think in one of the recent commentaries it said when inflation is coming down really significantly, is I think how they worded it, and we have not seen the really significantly part yet, but I do believe that if things started breaking much more than they have, that we would see things change. I think we would see, you saw that basically after after the March situation with banks, and then the June meeting came along and they stopped, mm-hmm. and then well in advance of that meeting, they were communicated the intent to stop or the pause. I think even they were communicating a full stop, but left it a little bit open. People spend much more time going like, word by word by what the Federal Reserve is saying. But I mean, really, if you look at what they've been saying and what they've been doing, it's been very consistent. So I think they want to be taken seriously in their intent. And if their intent is to bring it down to 2% with maybe some average band around it, because prior to the pandemic, there was a target range. It wasn't right. So if we come into that range, I think they would stop. So again, I think something breaking would make them stop. Otherwise, coming into that range or seeing significant, which I think at this point we may see significant disinflation because at this point we are comparing year over year numbers that peaked last summer. So the gas prices peaked in July, right? And so because of the base effects, we're going to see inflation coming down pretty significantly in the coming months.
Why do you think we're not in a recession? Or maybe we're headed towards one. But it seems with this kind of rate increase, you would expect, I'm not an economist, but I'm wondering why we haven't, gotten to recessionary numbers yet.
Yeah.
And employment, by the way, and employment's still going up. Just doesn't make sense to me.
Right. Well, I think what economists brought this up, years ago, that we don't have enough labor out there. Our labor has been shrinking. There were many more people that retired during the pandemic than we were expecting, given the trend line. And the other thing, we saw a huge drop in immigration during the pandemic, which is now rebounding. So I think what really we have going on is not enough labor. And so everybody's employed, and when you're employed, you spend money, and so I think that's what's keeping us going at this point. Yeah.
Do you see any pressures on, what is your anticipation? As an economist, do you see us avoiding a recession with all of this?
Well, I think the recession calls have been, revised down in many ways. A lot of folks now don't have, call a recession in their forecast. They're calling from a, growth recession, which basically means growth below potential, but not a decline. Right. So I think, I think we can weather this out and maybe actually indeed come out of this with a soft landing.
Yeah. Well, that would be interesting. That would be interesting. Certainly from our perspective from my perspective on looking at what's going on in the multifamily real estate, it's hard to imagine that there'll be a complete soft landing in terms of real estate. But well, who knows, right? So Selma, tell us a little bit about Corelogic.
Well, Corelogic, as I mentioned at the beginning, we're a premier provider of data, residential housing, most residential data and solutions. And so we collect, thousands of data sets across the housing ecosystem, including property records data, MLS data, mortgage performance, mortgage servicing, mortgage originations, appraisal data, tax recording data, permits data, and now the latest data that we use in the latest data set analytics solution that we developed using all of this data is climate change or hazard risk scoring by property. So basically, you can go property by property, and there is a risk score of potential hazards, and we do hope that with that consumers, others, asset managers as well, will be better informed about potential risks geographically, right? Because there are areas that are continually, there's this issue with insurance in California, right? There's the same issue in Florida. And so this is something that we all need to be better educated. So the idea of this solution climate change solution is to help with that.
The website is Corelogic.com. Selma, thank you very much for joining us on Wealth Formula Podcast.
Thank you. Thanks so much for having me.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. Just kind of a crazy market we live in, right? And boy, all I can say is I am glad I did buy a house. And who knows how it's going to turn out? That's the hard thing that's, really hard to understand here is what happens if rates start going down again? Do people start selling? Is there more liquidity? And then because there's more liquidity, then does that actually paradoxically, bring housing prices down? It's all so confusing, but it'll be interesting to see what happens. That's it for me this week on Wealth Formula Podcast. Now, remember, I am doing multiple podcasts per week in some cases because I am trying to focus on this whole back to school model to get everybody caught up with, sort of some personal finance principles. So make sure to tune into those. And also make sure to tune into my other podcast, which is Sapio with Buck Joffrey. Sapio with Buck Joffrey is all about, health and longevity and that kind of thing. If you haven't listened to the show, make sure you do. I guarantee you it'll be applicable to you because you are a human being and you probably want to be healthy and live a long time. So go check it out. Sapio with Buck Joffrey. That's it for me this week on Wealth Formula Podcast, though. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.